Hello and welcome to Options Guide TV. My name is Brian Overby. I am your host for about the next, I'm just going to say 20 minutes here on Options Guide TV. Since we talked last, it seems like the market has decided that November is going to be the new October and had great earnings announcement from NVIDIA, an excellent conference call. Nothing was said that could have been scary about the marketplace and what's going on with AI. But I guess the marketplace just decided, you know what, everybody in the world is spending too much on AI, or maybe they just decided that AI is really scary. I don't know. But there is a lot of things that can happen with AI as far as, the old adage, you took my job, that type of thing. So massive spends on across the board on a lot of the companies. Meta got beat up for it, and Nvidia for saying that they're doing so great is started up, if you noticed, and now it has collapsed. And right now we're struggling in the marketplace. The VIX, the entire time, this entire week, has just hung out above the 20 handle, and now volatility has raised back up once again. So, like I said, this was the movement, the down movement that I was thinking is going to happen in October. And we're finally getting that down movement now. Not quite sure why. I do think that there is some advantage with NVIDIA. I don't know how you have to own some of it to hedge yourself, but obviously there's going to come with some volatility with it. And the market is down. So if you didn't have that opportunity to buy NVIDIA before, maybe this is an opportunity. But I think the moral to the story of earnings this week is that the AI story is, on the third level of a 100-story building. And even if you don't spend, you're going to be left behind. At least that's what the NVIDIA conference call and Jensen Huang, that is basically what they were saying. So we already have a comment. Let's go ahead and put that up. And close my NVIDIA skip strike butterfly right after the open yesterday for a profit. That's excellent. Good. I'm glad. And we did say that too, right? We said on the show that, and a couple of people did them short term. I do know we had a few that were out there that did them short term. And yeah, take the profit, especially the way the market was acting. Bitcoin is getting really taken out to the woodshed, and the market wants to go down. And it's a cleansing. I kind of feel that the VIX isn't always a leader of the markets, but it is always aware when the VIX just doesn't seem to want to come down, just showing that there's uncertainty in the rally. And we've had such a strong marketplace for so long with so many potential headwinds, tariffs, the fight with the Fed, and are we going to lower rates, and we need to lower rates, and everything that has gone on recently. It has been, and there just hasn't been any downside. So I'm not surprised that this has happened, but I guess I'm surprised that it happened almost because of the earnings that we had this quarter. And AI has been propping up the markets, and now AI is, and the conversation and the spend and everything that's gone along with it is driving the markets down. Now, Google has been a stalwart, and they're showing their prowess once again. So Google is up today 3%. And we see Apple, so we see a few of them still doing just fine. Amazon's getting beat up. AMD it also is getting hurt, down about 5% on the day. Banks are kind of flat. Gold is off a little bit, so I guess we are a little bit mixed, and it is good to see that after Home Depot's earnings that they're doing pretty well. They're up about 2% on the day, and the Walmart trade that we did right now is doing okay also in that we were dead wrong. So Walmart came out and said that the customer was doing pretty well. We were looking for a big move to the downside potentially. And now Walmart was one of the stocks that was up yesterday, and it's trading at like right around 106 right now. I'm going to actually got to scroll down in my watch list. It's a little bit lower. 107. 106.19, 106.19. So it's given a little bit back today, but as long as it stays above 100, we're fine. And you could take that trade off right now. You did it for a decent net credit to the account and probably be close to break even on it. I actually did. I like that Walmart trade. All right. And it's fine. You know, that was part of the reason of doing the pay later put. And that's the advantage of the pay later put, is that if the market doesn't kind of go down, if the market actually goes the opposite direction, you did it for a net credit. If everything expires worthless, you make that net credit. So here's what I got for you today. And I'm a little bit under the weather, but I did want to talk about this hedge, and I thought it was fairly important to soldier on with the show today. But with this said, NVIDIA is trading at 175.76. There is an adjustment if you wanted to do the trade. But like I mentioned, the VIX being up, the general market volatility being up, the fact that the market has tanked in NVIDIA has driven up the implied volatility. And we're still seeing these option contracts trading at 53% implied volatility. So we still got an increase in vol, and that's because the market is dropping precipitously. But that allows us to adjust the trade. And it just so happens that we're at a real interesting precipice right here where we could adjust this trade and we could still be profitable on the trade. We did the trade yesterday for $5.70. But this is a scary adjustment. I want to let you know that this is a scary adjustment to the trade. $5.07 or $570 at the midpoint. And here's what the trade was. We went out to December 19th. We did a 1 by 2 by 1. We bought the 185 calls. We sold 2 of the 250 calls. And then we stopped short on the short spread and we bought 1 of the 215 calls. So in that instance, if the market did go up above through all of our strikes, we could still be profitable. This thing would trade for $10. And we paid $5.70 for it. So we had a nice solid room of profitability, almost a doubler on the trade. We paid $5.70, would have been able to make $4.30. All right, here's where the trade is. Here's the adjustment. And this is more of just a learning thing. You can sell it and get out. Like as mentioned by a couple of people on the show already, they were able to get out yesterday for a profit. And now here we're trading for $4. We could very possibly just close the trade. You're down 170 on it. But if you wanted to make the trade profitable, but there's risk. Okay, so this is why I'm saying this is a very interesting time to make this adjustment. If you look at our short strike, we're at the 205 strike. That strike right now is exactly a 1 standard deviation move away. And that's why this screen is a different color. And if you look at the delta, 1 standard deviation move is about a 16 delta. So there's a low probability. There's only a 16% chance that the market would come back to this strike by this expiration. Now it's NVIDIA. So you got to throw some of the, the math is what the math is. But this would be a scary adjustment, but you could get profitable. So here it is. I'm going to remove this option contract. So we would be selling this one and we'd be buying that one. And then we're going to end up in this trade. So I've got to remove our middle strike. So don't forget, we have the 205 strike and we're short 2 of them. So we're going to close that. We're going to take this position. We are going to sell the 185. So this goes from a buy to a sell. And it would be sell to close if you have the position on, but we don't have it on in this test account. So I'm going to have to hit sell to open or it'll get mad at me. And then we're going to buy an additional 215 strike. So we're going to sell this, buy that, and notice we're getting that done for 605. So if we did that, net credit, we'll call it $6. Let's say $6. Because like I said, this is a little bit scary, but $6. And everything looks great if you do this, right? But the risk doesn't. So if you do this and you get this done for $6, you paid $5.70 for it. You have a potential to make 30 cents. I don't want the cheese anymore. Just let me out of the trap. High probability of success on the trade, on the markets going away and you basically getting out, with a little bit more than your commissions. I mean, 30 cents is a decent trade, on 570. On a percentage basis, you're doing all right if you make 30 cents on this trade. But if we do this, we are going to create two short spreads. And they're going to be short call spreads. This will be a bear call spread trade. But we pull this whole trade off and get it done for a net credit of 60 cents. We're going to be short two, and that's the downside. We're going to be short two short spreads from the 205 level to the 215 level, which would be $2,000 of requirement because you'd have $2,000 worth of risk. And we still have 28 days until expiration. It's a very interesting trade. I don't know if I would do it. Personally, I wouldn't want that risk. And the fact that I could still get out of this butterfly for $4 and I could only lose $1.50 on the trade with the way the markets reacted, I would personally do that. Now, I'm already out of the trade. I got out yesterday too for a small profit on the trade. But with that said, this is a viable adjustment. Now, there's also one other adjustment that you can do, but it wouldn't make you as profitable, but it would take off a lot of risk. And these adjustments I do all the time on butterflies. By giving yourself some time, giving yourself 30 days, it gives you that opportunity to make adjustments on the trade. So the second adjustment, because we have time premium, is not to sell the 185 and buy the 215s. We're going to buy one of the 205s back. We're going to have to spend more, and we're not going to make it profitable, but our risk is going to be greatly diminished by doing that. So here's the second adjustment that's possible. We sell this. We have this option contract still. We're selling the most. We're taking advantage of the fact that this is closest to the money. And then we are going to buy the 205. And I see a bunch of questions popping up. I'll get to them. And notice this moved down here to the 205. Now we're bringing in a net credit of $5. We're going to still have $1,000 worth of risk, but now we're down 70 cents on the trade. And, nobody wants to make an adjustment, put on risk, and still be down on the trade. But adjustments are what adjustments are. So less risk, mainly because you're only going to be now short one 205, 215 short spread. You're going to be short one 205, 215 short spread. But we bring in less of a credit. We bring in $5 and we put this position on for $5.70. So our ultimate position, and so I'm going to leave, let's send this to the what if calculator. Okay. Not to mention the fact you can just stay in the trade too. You can let it ride. But at this point in time, with the way the vol is, I think I would just adjust the trade and do a different trade. And I wouldn't let this trade ride because the volatility is saving you and making the trade profitable. The fact that the vols are so high, when you're in a butterfly, if the stock goes away from you, if stock doesn't go the direction you want it to, volatility is your friend. You need your long options to help you out. And that's why this trade is only down $1.70 after this whiplash of a move in Nvidia after a great I mean, they even blew away the whisper numbers. Nvidia's been so strong that none of the analyst numbers over the last I don't know how many quarters have even been close. So nobody really even pays attention to them. And they even blew away the whisper numbers, and they had such great comments afterwards. Okay, so here we are, 185, 205. I put that in here. Like I said, I'm a little bit out of it today, a little bit of fuzzy head. Okay, let's put the trade. So if we did this trade, that erases this option. Remember, that's a sell to close. So that would erase that option. You would then, this would go back to being short. And then this one would be long. If we made that second adjustment, this would be the position. And I'll send that one to the what if calculator and show you this is where your risk is at. Okay, so the market's at 177. You have 28 days until expiration. Let me pull this down. You have 28 days until expiration. And you need the market to come all the way up to the 205? Yeah, 205 level. That's where our short strike is. And then I have a risk of $1,000 from here on up. I don't know. What do you guys think? Let's go. Okay. Good morning to, I guess the @ symbols are the things today. I don't know why they're a little bit odd. We're not really seeing the names, but that's fine. And then let's look at, let's look at Dougal. Would you consider selling a put credit spread to make an iron condor? No, I don't like what the market's doing in this trade. I don't. Things are flushing out right now. So selling iron condors or selling premium is scary to me. So this trade is scary, but I don't want to dive in with but it's not a bad idea, and it's a great suggestion. So we bring in, we just do the one credit where we have $1,000 worth of risk, where we buy back one of the short options in our butterfly, and then we go lower and we sell a put spread that would be 10 points wide and bring in an additional credit, and then we just hope that it stays within that range. I do not mind that. That's not a bad suggestion. Okay. Did we get to the last question? Okay. Two of them to take advantage of the requirement you already have on the call side. Oh yeah. So that, I guess that was during the question of the other one. So yeah, you would be able to, you would not have any more additional margin if you rolled into an iron condor. And I can show that. Let's just do it on. Well, if I did the iron condor, I would definitely do the second adjustment where we only created a $1,000 requirement. I don't want to do that in this trade because, like I said, right now there's no rhyme or reason as to why Nvidia, to the reaction to Nvidia and what happened there. I don't really have a lot of rationale as to why, but let's say we were going to do it. Go down to the one standard deviation move, looking at 16 delta right over here. You would go 1 point wide. So you have the 205, 215 on, and all of a sudden I am spinning. Okay. And then I would sell so I would keep it a true iron condor. You're looking at 150 to the downside. You're looking at a one standard deviation move. Sell this one. This isn't going to be as enticing because of the vol skew, and the vol skew is helping us in our butterfly. But we're going to have to pay. Like you can look at, we're going to have to pay up for these puts. This volatility is 62. We're going to look at the 140s, and that vol is 67. So there's 5 points of volatility skew. So you're not going to get as nice as a credit as you might think, but let's look at it. Okay. We can add this. I'll leave this position here, and we'll sell this and go 10 points down and buy this. No more additional margin. The downside of that is I don't know exactly what we brought in. So I'll remove this one. Well, let's send that to the what if calculator. Show the profit and loss graph. And then let's go back to the trade ticket, and we'll drop these two. And that brings in an extra $1. Okay, so that would make us profitable. It would add our risk. Our total risk wouldn't go up. In other words, the marketplace can only go one direction. We can't have it go up and down at the same time. So only one spread can cost us money. But if we did that, and I said this wouldn't be that enticing, and I did mean that, in that when you get these big downturns, especially in these big name stocks, you see that the 150 to the 145, that volatility skew is really hurting you. This is 62 and this is 67. You're paying an additional 5% of volatility premium when you buy your protection at 140. But brings in another $1. Now you would be profitable on the trade if the market can stay between 150 and 200. You got a 50-point range over the next 30 days that it could stay in. One thing that is true is, man, you go into the weekend here. You might wake up on Monday and the vols are down to 40, just because the market has settled down. So there could be some benefit just because of Vega, a collapse in volatility over the weekend. So I guess I don't mind it as much as I thought I did. Do you really think NVIDIA can drop another 25 points? Who knows? Who would have thought that it was going to swing up 10 to almost to, I think we're up 7 or 8 all the way to down 5. And that's what the swing was yesterday. Any other questions? All right. So now on Walmart, and I got to admit, I don't have the Walmart trade right here, but let me go and set that one up. I did a lot of trades in Walmart on many different shows. We talked about them. So and last, do you think any of this NVIDIA move is end of the year selling? Yeah, I think it's 100% driven by NVIDIA just has been so strong, and they had such a strong earnings report. And, back in the day, if you remember, Apple would always do that. It's kind of similar that Apple was such a strong company. When iPhone sales were going through the roof, they always had a tendency to sell off whenever they announced earnings. And I see some similarity here. Now, with such a strong growth with NVIDIA, they really blew the numbers out of the water. And didn't anticipate at all. I guess my outlook or my thought was wrong. I was right for one day, for half a day. I own a lot of NVIDIA, and I'm not panic selling. I own the actual underlying stock, and I plan on holding it. I think it does have to be a staple in your portfolio, but the stock is 7% of the index. And, so if you own any indexes, and you own a lot of NVIDIA because of that. So always realize that too. And that's, why the markets have struggled a little bit today too. Markets are back up now. So heck, maybe the storm has passed. NVIDIA's bounced a little bit too. And that's probably why the market's back. That's because it's such a big part of the index. I do. So I'm not panicking in NVIDIA. I guess to put it that way, this doesn't make me panic. If I didn't have any, I would do make this a buying opportunity. And one of my shows, we actually went out, and I think I might have mentioned it. We and looked at uh, buying a deep into money call. So here's one of the things, I don't mind buying deep into money call option. I think the vol is a little bit high. I would probably wait until Monday, and I said that on the uh, it was actually a newsletter that went out. I was trying to say that it was a podcast, but it wasn't. It was a newsletter. But I did mention that, one of the hardest things is vol is high. And if you're buying longer term options, you have a lot of time premium, and vol does hurt the position when volatility is high. So I'd maybe wait until Monday, even if you get a little bit of a bounce back today. But as let's say you own 100 shares of Nvidia and you really wanted to own 200 shares, right? But I own 100 shares just because I only have enough money to buy 100 shares. Let's go to June and go down and look at the 80 call, 80 delta call right here, 142. And here we go. We'll go just a little bit short. This is 140 difference, 8 by 830. That's a decent market for that expensive of an option contract. Going out 209 days, and we got a good market. And that's probably because the markets have been so volatile. Buy that. There you go. Now you got 80 shares of Nvidia for $5,000. For $4,800. And so in other words, I'm kind of doing the dollar cost average thing, right? I own 100 shares of stock. The stock got beat up. I don't have enough money to buy another 100 shares. Why don't we buy a deep in the money call option and double up to catch up, if you will? And the one thing that's nice about buying the deep in the money call options is that the strike is 80 right now, or the delta is 80. And as that goes up, that delta is going to increase, right? So as this goes up, that means it gets deeper into money. So the delta is going to start going, and eventually you would have something that acts a lot like the stock. The delta could get as close to 1 as possible. And when the markets go down, the delta goes down. So it hurts you less. And this becomes an at the money option contract. The delta would be close to 50. So if I was wrong and the market came all the way down to the 144 strike, I would lose money slower on the way down. And my rule usually is when I'm buying deep into money leaps is that if it ever does hit the strike that I'm using, I'm just going to sell it and get out. I'm going to capture whatever at the money time premium I can get. You could also say that if this gets cut in half, if I'm down 50% on the trade, I'm going to get out. But whatever you do, is try to stay consistent with it. My rule has always been that if I hit the short strike, I get out. That's my stop point on it. But on the way up, you ride it. And if the delta gets to 1, I roll it and go back to an 80. And then the delta is almost a wheel strategy. But not a bad place to try to take advantage of the fact that the stock's been beaten up. Now, if you wait till Monday, vols might come in. You're getting 48 vol out here. It's not horrible. It's still not hanging around quite as much on the shorter term options. Not horrible. And I wouldn't mind doing it today because it looks like the market wants to come back, which would make sense to me. All right. Well, that was a lot. We're actually at the end of the show. Let's look at Walmart real quick, okay? Getting a little bit more energy here. And I think we stayed 30 days, right? I don't know the exact, like I said, I did this on many shows. So we did do 30 days. Anybody do the Walmart trade that's out there? And once again, nothing's meant to be a recommendation. I always got to emphasize that on the show. But I know some of you guys will do these trades. So you're 100. I think we did. Nobody's piping up in the chat box, but I remember it was 5 points wide. We did sold this put and just did one of them. Sold this and bought 2 of the 95s. 1, 2. Yeah, so that's about break even. I think we did it for a net credit of 30 cents. So you could get out. and why not? Just close it. You did a trade and we're dead wrong on the forecast, or well, it didn't pan out. This is a pay later put, otherwise known as a put back spread. And I'll show you the what if calculator. It's at literally trading. That's not right. Let's try that again. Buy, sell that put, and buy 2 of these. There it is. That's what we were looking for. I don't know what the heck happened that last time around, but this is it. It actually even inside the Tradier Pro platform, it says ratio back spread, and that's what it is. And the reason why we call it a pay later put is that you sell this, you get it done for a net credit. You really just want to buy a put, but if you do this, you don't have to buy, you don't have to pay for it. But if the market kind of goes down, you do at expiration. You would end up paying that $5, and that was about what the 95 strike was going for. And then ultimately you need the market to tank. You need it to go, more than the expected move and more than the one standard deviation move. The good news about doing a trade like this and yesterday in Walmart with vols high is that it takes a while for the market, and I'm just drawing like the profit and loss graph, to go all the way down to the 95 level. It takes time to get down to there. So that's where we're at. And so that trade turned out fine. Not bad overall. I mean, I made a few dollars on it. And it looks like a few of you did too. All right, everyone, let's call it a day. Weekend is here. No trades. I definitely don't want to do a trade over the weekend at this point. The markets are befuddling, to say the least. See you Monday, 11 a.m. Eastern time, for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.